All right. Welcome everybody to Minus Investing Live. Happy Sunday afternoon to everybody out there. Hope you guys are having a good afternoon, a good week. Happy Super Bowl Sunday to those of you that are a big fan of American football. Not really a big sports person myself, so I'm definitely not watching it. Perhaps that should be, I guess, obvious since I'm streaming today. If I was watching it, maybe I would be getting ready to watch it or something like that, but who knows? Maybe some of you will find time to come hang out with me for a little bit before you watch it. Or maybe you'll just watch it after the fact, but that's cool too. But either way, I got lots of things to talk about today, I think. Let's see how long we go for today. Right here, right off the bat, we have, or actually right off the bat, before I even get into anything related to the portfolio, I will ask if you're watching live or on the replay. It would be really great if we could start off the stream with some likes. So if you're watching now, and really appreciate it if you could like the stream, hit the notification bell and subscription if you haven't already. That way you get notified whenever I put out new content, as well as whenever I go live, such as now, so you can make sure you're here, as well as you can watch the new content whenever it comes out. And on that front, I did actually put a valuation video out this week on Heidrick and Struggles, ticker HSII. It's not gotten a whole lot of views, which it's not a very highly covered stock, so it's not too surprising on that front. But even so, even for my own views, perhaps it's just because I've been on a bit of a slowdown, so I think my views are on a slowdown in general. But I really think that company has an interesting opportunity to it. So if you haven't watched that video, I would heavily recommend you go check out that video, and of course give it a like while you're out there, and maybe even a share if you have somewhere that you can think of to share it to. But beyond that, also, if you have already liked the stream and already subscribed to the channel, if you like otherwise, there is the link in the description below, as well as the pinned comment in the chat to the Discord, which you can see right here. Come join our Discord, our group where we have daily discussions of what's going on in the market, what's going on in our own portfolios, the actions of major investors, analysis of companies we're interested in, and things like that. So come be part of the discussion there, link in the description below. And last but not least, if you're already like the stream, you're already subscribed, you're already part of the Discord, and you want to find other ways to possibly support me and help the channel out, there is also PayPal links in the description below, as well as other links like that. If you want to donate to the channel, that would be really, really appreciated. And then beyond that, there is also the dashboard, which I am currently trying to find people that would maybe be interested in essentially getting a subscription to this. You can get your own private Google Drive link to a copy of this file that gives you access to all of the companies that I have full valuations of, as you can see right here, as well as the lookup table for the annual financials as I've organized them for my valuations, as well as the DCFs and the assumptions that go into them, including the distributions of the values that I've come up with and stuff like that. And then, as I've also been talking about in the last couple of weeks, I am currently trying to add other things to the valuation dashboard, such as a main market monitoring page where you can monitor all sorts of things going on in the bond markets, as well as commodity markets and the equity markets, of course, sectioned off by a variety of different types. As well as I've been trying to work to add a macroeconomic tab as well, so you can monitor what's going on in the US economy, as well as perhaps the international global economies is stuff that I'm going to be looking to add as well. We'll be going over some of the additions that I've made to this page in the last week here today. But anyway, the point is, as I was kind of just saying, this I'm trying to offer to people who would like to subscribe to this dashboard for $5 a month. I currently don't have anybody subscribed to it, so I don't have a super fine-tuned setup for how you would sign up for this. So essentially, if you are interested in perhaps subscribing to this dashboard for $5 a month, as I said before, comment in below, or possibly join the Discord and hit me up there privately. Either way, I can get back to you and we can try to arrange something like that if you are interested in having access to essentially all of my research on a daily basis. So anyway, we'll actually get into stuff. Enough advertisements for my content and the products I'm trying to offer. Here, looking at my portfolio, there has been some changes in the portfolio, which we'll get into talk about here. In the last couple of weeks, as I was just talking about, obviously my valuation video for Heidrick and Struggles has been out, but I have been buying that one more and more. It's now up to 2.1% of our portfolio. I think it was only like 1.5% last week or in the last live show. So you can see it's moving quickly within a minimum range of 2.8%, possibly going all the way up to over 7%. So we got to get at least another percent up there in order to have it up to full size. But then we would have plenty of room for it to let it ride. As you can see, my target ranges, which include a minimum level we'd like to get things up to, as well as a cap level for which we would at that point be looking to potentially sell depending on the individual position. So yeah, HSII, very, very excited about that position. I've also been buying more of Silver Corp, which is another one I've been talking about a lot lately. I also have a video out on that one. I'd highly recommend people check that one out, as well as New Gold, which I don't have a video out on that one, but I have been talking a little bit about that one. I'm still very excited about that one, but that one's definitely going to be a smaller position, I think, because I have a little bit less confidence in that one compared to the other ones, which should be obvious considering I didn't make a video on that one, whereas I did make a video on the other two. But then there's also Global Net Lease, GNL, right here, which is another one that I'm doing more of a pricing analysis, a simple DCF kind of approach to it, and haven't done a super close analysis of it, and I'm probably not going to make a video for it, but I have been buying a little bit more of that one lately. And then I added another position this week, that being Mosaic. Mosaic being an agricultural input company, fertilizer company, which I've been paying attention to fertilizer companies quite a bit. If you've been paying attention to the channel, you would have seen me talking about fertilizers a decent amount in the last 6 to 12 months. I've valued them here and there. I've even looked at Mosaic a little bit before, and then I didn't find them as appealing in the past, but they have come down in price pretty significantly, as well as I made adjustments to a lot of the assumptions that I was putting in there. So it's a little bit of work on my end and a little bit of work on the market's end, but Mosaic started to look like an actually interesting opportunity. Now, I didn't do a super full analysis and build a full revenue model for this one. It really is a simpler DCF still and pricing analysis that I'm relying on, but I probably will eventually get around to doing a more full model for this one. I think maybe I'll make a video on it, but I haven't decided. We'll see once the model is done how I feel about it essentially. But the point is, I did decide to jump into a position preemptively though, because of just some of my feelings around the agricultural space, as well as the fact that the pricing analysis backs up the basic DCF I did. So I do feel like it's a reasonably safe position. And I have been trying to get more positions into the portfolio, not because I want more positions per se, but I am trying to get my overall position allocation up and trying to get my cash allocation down, as well as getting my index allocation effectively down, which it isn't really effectively down. As you can see, my index allocation is still relatively high, currently around 28%, but that's also partially because I did change some of the ways that in which I'm managing my index position along with my cash position. Now, for people who've been paying attention to the channel for a while would maybe know a little bit more about how my index position works, but essentially I'm using my index position as a way to make sure my portfolio is more fully allocated to equities, even when I don't have enough positions allocated up enough to get my cash position down to the level that I want it to be. This is essentially just a stopgap to make sure that I have enough equity exposure. However, I do think the S&P 500 in general isn't necessarily the safest instrument to hold due to a lot of the concentration and a lot of my concerns about certain aspects of the macroeconomic environment. And so I do believe there's a lot of downside risk potentially when it comes to holding the S&P 500. So I do have a strategy that I use to tell me when it's a little bit safer, according to a lot of momentum indicators, when it's a little bit safer in the short run to hold more S&P versus less S&P. And previously I had been lowering or raising my equity allocation to the index level based off of that, and essentially just shifting it back and forth between cash and index based off of how those momentum indicators were telling me. But the point is the way in which I was allocating it before, I still had too much cash and not enough overall equity exposure. So I changed it now to make it so that we actually just, the amount that we allocate to the index is entirely dependent on where our cash range is. So essentially from now on, we shouldn't be significantly over our cash range at all. We might actually be below our cash range more often than not, and potentially just right up around the cap level of our cash range. So as you can see right here, our current cash range tells us that we should be somewhere between 5.7% and about 11% for our cash level. And we're currently at 8.5%. So we're essentially right there in the middle, which is good. We had way too much cash last year. It's a huge reason why our returns were significantly lackluster throughout most of last year. And we're not really looking to make that same mistake going forward. Now, of course, how well that's going to work out for us is entirely contingent on how good that momentum strategy is, and also how good our actual picks are. So we'll see how that plays out, of course, as well. So that's a pretty brief summary of all the changes in the portfolio this week. There was, as I said, a decent amount of kind of changes strategy-wise, as well as addition to the portfolio, and then really just buying more of some other stuff. Obviously, there has been a decent amount of earnings that came out this week, which affected some of the positions in the portfolio. In particular, we had the earnings of PayPal come out, which I'm definitely going to talk about a little bit, since there was a decent amount of downside action on that one. And since I have a video on that one, people like to talk about that one a lot, I figure I should probably make some comments on my feelings around that and changes to the value that I've made based around that, as well as Silver Corp, that silver miner company that I've been buying up, also reported their earnings this week. And that one had a little bit more of a positive reaction on its earnings, though not quite as extreme. And I'm very, very happy with seeing the progress there as well. We'll be getting a lot more of our portfolio reporting earnings in the next week. I think it's like almost like 40% of our portfolio or something like that reports next week. So I'm definitely very excited to see how that all plays out. But yeah, in the short run though, but we'll have to see how that all plays out. Like I said, we'll talk a little bit about the PayPal valuation in a little bit. I'm going to get through some of the other topics before we actually do get around to talking about that. And then I was also going to show a little bit of what I've got going on in the Mosaic one as well, in there as well. So let's see. There was one other topic I kind of wanted to bring up. Obviously, it's been a topic a lot of people have talked about in the last year, 2 years, 3 years, I don't know, depending on what time period you're looking at. But concentration within the index has been a huge rising topic. Some people were talking about it in the Discord, and that's actually one of the things that made me go looking at some things related to it. Here you can see, for example, there was the Magnificent Seven that people have been talking about all throughout last year. The Magnificent Seven were the top performers: Nvidia, Meta, Amazon, Microsoft, Apple, Tesla, and Google. The top weights within the S&P 500 and the NASDAQ in particular last year that had massive outperformance. And then in the last couple months since 2024 started, there's been a little bit of a divergence between a few of them. Apple, Tesla, and Google doing not so hot, whereas Nvidia, Meta, Amazon, and Microsoft have been doing a lot better, partially off of the back of the earnings announcements that we've seen, which you can see was really just a giant leg up here. Meta themselves also reported earnings and had a really, really great time. I didn't mention that one earlier as well. But the point is people have been talking about concentration within the index in general, and this kind of made me want to bring up the topic because I think a lot of people, this is something I talk about all the time, that a lot of people don't look back to history. A lot of people have a very narrow focus in equity markets. If they've only been investing for 5 years, then maybe they look at the last 10 years or something like that. Maybe they invest in the last 10 years, they look at the last 20 years, something like that. But the point is the amount of history that people tend to look back on in terms of shaping their view of what's normal within the markets is something that I think a lot of people don't go back far enough. Essentially, they don't really use history and all of the as the tool that it is, all the data that's out there. And a lot of the reasons people tend to do that is a lot of people think, oh, well, it's different this time. It's like how similar is today to the 1970s, for example. A lot of people will be like, equity markets are different today. Technology is so different today. So how can we possibly think it's the same? And well, the truth is there's actually a lot in common. There are more similar than you might think. So for example, I went and found a few charts of people talking about portfolio concentration over time. So this chart only goes back to 1980, but that's still one of the furthest back data sets I could find on this. Here, just showing the weighting of the single top holding. So the number one top holding within the S&P 500 from 1980 to 2023. I can see IBM having peak levels of 6.4% back in 1985 or 1984. I'm not 100% sure which bar that's supposed to be exactly, but essentially way back then we had 6.4%. A lot of people talking about 7.4% of Apple here in the most recent time frame. It might be overtaken by Microsoft depending on any given day or whatever like that. I don't know exactly when this chart was made. It might have been a few months ago or something, but the point is as you can see, it's like, we have periods of high concentration that come and go, and then the concentration kind of moves back down. The length of the time frame and the reason why it goes up and down, there's a lot of things you can argue what's causing that. Interest rate movements probably have a significant portion to do with it sometimes, as well as the birth of certain technologies are going to affect it. Obviously, these are in somewhat different industries depending on how you look at it. We have enterprise software. This one was enterprise software to a certain extent, but also consumer facing software. Then we moved all the way into oil, which is interesting, and then into consumer facing electronics. though obviously now a lot of services in the more recent years, but still electronics in terms of like when it was dominating. So it's, it's interesting to kind of pay attention to this. And something that changes a lot over time. Now, this is just a single one top holding. And I found another chart right here showing the top 5 companies, the weight. Here it shows the percentage weight for the top 5 companies. Now, in this particular chart, it shows the current time frame we're in as being especially concentrated compared to the past. But this chart itself goes back to 1969, which is good. Showing the Nifty 50 back in the 60s and 70s, had some peak levels that dropped back down during certain recessionary periods and then rose back up at other periods in time. Then the internet revolution, which is the period we were just talking about with Microsoft. You can't necessarily see there's no special revolution or generational thing going on to name why Exxon became the number one there. It probably had a lot to do, I think, with activity in the Middle East during that time frame potentially. But the point is, you can see it's like this is something that comes and goes. Concentration and then disbursement, and then concentration and then disbursement and then concentration. And then you have to keep in mind what's going on. Like I said, I imagine interest rates would have a significant effect on this too. We had relatively moderate interest rates and then relatively higher interest rates during this period. And then interest rates started coming down during this period. We had a little bit of a rise in interest rates, and then interest rates came back down again. And then low interest rates during this period, and then interest rates have been rising, though it's still continuing to come back during here. So maybe not a super clean relationship if you're talking about interest rates or something like that. But there's other factors that come into it as well. Now another chart right here. This one showing the weights of the top 10. Unfortunately, this one only goes back to like 88 or 89 or something like that, but it does give us more information. It also gives us performance for these S&P 500, the performance overall, and then the contribution to the performance within these time frames. So essentially, like, what is the returns of the top 10 relative to that significant levels of concentration? And then the actual companies, they include the top 10 companies as of September 30th right here, including also their forward PEs as well. All right, and then coming over, I showed you this one, which shows the top 5 weights. That same website gave me a few more interesting pieces of data that I thought was interesting to kind of pair with that to possibly explain why we have companies like the Magnificent Seven. They came to show here the trailing financial measures of those top 5 companies versus the S&P 500. Top 5, the EPS growth 19%, or sales growth 19%, EPS growth 19%, the return on equity 34% versus the S&P 500 overall 4% sales growth, 6% EPS growth, 14% return on equity. So, just like, look at this. It's like, why wouldn't you have a high concentration into these highly magnificent companies? They're actually good companies. They're cash flow machines. They're not just big companies and technology companies. They're actual productive capitalist machines. And then beyond that, we'll also include some information talking about the forward returns after these peaks periods of concentration. So post Nifty 50, 1 year following the peak period of concentration in the Nifty 50, we can see here the equal weighted versus market weighted returns. So obviously equal weighted did better here. Equal weighted did better in the post internet revolution. In fact, we had negative 1 year returns for the market weighted, and then the average between the two, which is a little silly in my opinion to use an average when we only have 2 periods here, but still nonetheless interesting. And then the 3-year analyzed return, still equal weighted, did much better post Nifty 50 concentration. Did better post internet bubble, though negative, but still less negative than the post annualized returns for the post internet revolution for the market weighted returns. And then likewise for the average. And then 5-year annualized returns, still better across the board. So yeah, a high concentration, it may make sense because these companies are in fact better. It is normal. In fact, we see it historically pretty significantly, but that doesn't mean that we should just ignore it and then invest in those companies, because you are in general still likely going to see bad returns going forward in those companies. Mr. Beast, how's it going, man? Good of you to join us. All right, so that was pretty much all I wanted to talk about in terms of market concentration. Just wanted to talk about it. Basically, like I said, the take-home points is that market concentration is more normal than you think it is. It just happens in generational waves. It's not abnormal to see the indexes get this concentration. It's actually pretty typical. But that concentration is usually driven by actual fundamentals. It's not usually just that some random companies ended up being huge. It's like, it is in fact the best companies to become huge. But that overweighting does in fact lead to poor returns going forward. That's, I guess you could say, the SparkNotes summary version of all that. over to the dashboard here. Mr. Beast, give a small summary. There you go. I just gave you the small summary right there. Is cheap temporary or not? Definitely not cheap. All right, so take a look at the dashboard. As I had kind of already commented on, we got some changes in here. I mentioned I added Mosaic to the portfolio and a few other companies to the portfolio. So that means on the secondary page where we have kind of some other valuations that I haven't made full models for, that you'll see that those ones are in fact on there. We have Mosaic right here, which you can see my fair value is currently at about $34 per share, $12 expected returns, and 33% percentile. So you can see it's not super undervalued, but the expected returns are pretty good, and I think it's sitting pretty well within the distribution. It's significantly underpriced. The pricing I get is like $67 per share, so very, very good on that front, and it is very, very oversold. So that's definitely one of the reasons I'm buying into it. It is pretty bearish momentum, downward momentum, and it has been distributing in terms of its actual share action. So maybe not necessarily the most exciting company to be hopping into right now, considering what can go on with it. But I think that I'm willing to kind of like buy into that one. Maybe it's at its bottom. Maybe I'll get lower prices and I'll be able to buy further, but that is what it is. I'll come over to here. You can kind of take a look at the basic assumptions to go into it. Like I said, I'm planning to do a more thorough model on this one. This is just some basic assumptions I kind of ran with here. But overall, we're essentially assuming that their revenues are for the most part going to be coming down for the next several years. Our base case is going to have them reaching essentially only a little bit higher than the current revenues that they're already were at in 2023, which is about 15 billion 10 years from now. So we're essentially just saying it's going to take about 10 years for them to reach those levels of revenues again. And then in terms of margins, they've had about 12% margins in the most recent year, with 25% in the year before that. We're assuming that 12% or so we're essentially going to have in that range for the next 10 years. It's going to be about 11% for the next 10 years, and then ending about 10.8% thereafter. You can see the margins coming down like this. And then capital expenditures, they're not really a super capital intensive business. There is going to be some capital expenditures in the first few years, but that's going to move towards net neutral levels of reinvestment overall, getting us to free cash flows of about $1 billion and change, maybe even close to $2 billion on some of the more positive cases in the 10-year forward period. And then along with that, we've got some terminal multiples in the kind of like 11 to 12, maybe 13 range kind of overall over here. And then that gets us the distribution that we have. So yeah, like I said, I'm going to do a more thorough analysis of it, of the production levels, and then project based off of that, and then make projections based off of the fertilizer prices I'm expecting. I have kind of like a little bit of a macro perspective on why I'm interested in fertilizers, admittedly, and then I'm obviously generally pretty interested in commodity companies in general. This is a commodity company, so I don't recommend people take this investment super lightly, but I do think it's an interesting company with potentially an interesting opportunity to it. So that's definitely why I'm taking a look at it. All right, now also come back over to the dashboard. There's other companies that appeared on this secondary page, like for example, Alibaba. I didn't actually pull the Alibaba DCF out. I kind of wanted to show that one too. So I did do a basic DCF on Alibaba, which looks pretty good. As you can see right here, I have fair value on this with these assumptions at about $84 per share. Expected returns close to 13%. Not quite as good on the distribution or whatever, but still pretty good. Now I'm probably not going to be investing in it, but people have been talking about this a lot and wondering about how good the value was. And I figured, you know what, with the new template and all the different workings within it, I figured, you know what, I would take another look at this one, since obviously I valued in the past with my older templates and I didn't have very good value coming out with that, but all the changes I made with this make a significant difference there. So I was like, well, let me see how I think it looks now. Now I do think I'm using reasonably conservative assumptions in general. In my base case, I'm assuming that their revenues in the 10-year forward period are essentially just going to be only a little bit higher than really where they currently are, essentially only like 12% higher 10 years from now in our worst case scenario. And then in the bull case scenario, we're assuming that it's going to be close to a doubling in the revenues over the 10-year period. And then the base case is about halfway in between there. Now, obviously, they've much more than doubled their revenues over the last 10 years, a few times over that. So the idea that they're only going to double their revenues might seem small compared to a lot of other people's expectations of growth that they've had, and what they might be expecting going forward. So, that means our 10-year forward CAGR on average for revenue is 3.8%. It's a relatively low level of revenue growth that we're expecting in here. And either way, we still find it to be fair value, as I said before. And then operating margins, we're assuming their operating margins are going to keep coming down because they've been coming down pretty significantly in the last several years. And we're assuming that they're going to bottom at some point in like 2028, 2029, and then they'll start to move back upward towards like a stabilizing level. But overall, for the next 10 years, we expect their margins to be about 12%, and then ending at maybe about a 14% in the terminal period. And then along with that, we actually do expect them to have net negative reinvestment in the next few years, but then they'll move towards a higher level of reinvestment in those middling years where they have the low margins, and then toward the middling level of reinvestment in the terminal level as well, kind of stabilizing their overall reinvestment levels going forward past that point. But that gets us to free cash flows in terms of Chinese yuan of around anywhere in between 50 billion and 150 billion. It's kind of a wide range between 50 and 150 won 10 years from now. Again, that's in Chinese yuan, so you would have to convert that. But then using also terminal multiple assumptions, that gets us kind of like mid-teens or like low teens in general on average, but with some potential for it to be single digits and some potential for it to even be in the 20s. So a very wide range for the terminal multiple, and then that's how we get the distribution we get. As you can see, it skews pretty heavily to the right. So yeah, our fair value is about $84 per share, which is kind of like right here, but we can definitely see it being worth close to double that. That's not unreasonable, depending on some of the assumptions we use here. And I think we're using very conservative assumptions in terms of the reinvestment levels and in terms of the growth rates. So it's very possible that Alibaba could do very, very well for people who are buying it at these levels or lower. I myself am not going to, because I'm very, very pessimistic on the Chinese economy on a terminal basis. So even if this company might be a little bit priced to handle that, I think potentially for the next 5 to 10 years, I don't necessarily want to take that risk myself. And this valuation does not take into account any of the geopolitical risks that could be associated on investing in a company so heavily reliant on China. Like, for example, if there was to be growing tensions between the US and China to a major level, where, for example, investors have there's larger restrictions on foreign investors in Chinese companies or something like that. This valuation doesn't take any of that into account. So you would probably want a margin of safety to account for some of those risks if you think those risks are substantial, which I do. So there's a number of reasons why, even though, yes, I find it to be undervalued here, I would actually have to find it way more undervalued for me to want to actually use it as an investment, even for a short-term play. Even if it's just like a year or two swing, I would want a much lower level than that. But the point is, if other people are interested, and if for some reason you want to rely on the numbers that I just spit out here without doing that much research, then, here you go. I do think it is potentially and pretty likely undervalued, at least to a marginal level. So that's Alibaba. That's another one that we threw up on the kind of secondary page, like I said right here. And then beyond that, I also added Humana. This one came as a request from one of the viewers of the channel, members of the Discord, who themselves had an investment in it and was very interested in it. Now I show it as being basically about fairly valued right here, but without going in details within it, I will say that there's a lot of uncertainty I have surrounding that valuation. I think I'm being reasonably conservative in the assumptions I did in that valuation. And since it's such a low margin business, that means small deviations to that margin to the upside. If they surprise and they actually do a little bit better in terms of their margins, that has a massive effect on their valuation. And that's also true, I think, relevant to the revenues as well, because they're in an industry where they could potentially grow quite a lot, given the dynamics of the healthcare space over the next decade. And my valuation here doesn't really apply a whole lot of growth to them. So it's potentially possible that I could be massively underestimating both revenues and margins for this company, and that would have a huge effect on the valuation going upward. But that's true to the downside too. So the point is, I think I'm being conservative here, but that's about as fair as I can be to them without doing a much more thorough analysis of them and maybe making a model for them, which given the industry they're involved in, I'm potentially interested in doing. So it's possible that maybe I could do that at some point going forward. We'll see how I feel about that going forward. So that's pretty much all the changes to the companies on the dashboard. Beyond that, we can come over maybe to the market page and take a look. See if there's some major deviations over the last week. You can see, for example, here the 10-year Treasury rate, the 10-year inflation protected rate has come up pretty significantly over the last week. Now, this is representative of real growth estimations by the bond market. So in general, this is a positive sign for growth in the economy. However, it is not a good sign for equities, because that would mean that bond rates are coming up in general. In fact, we can see the 10-year overall did move up about 4% on the week itself. Now, since this moved up 14% and this moved up 4%, if we do the math between those, that means that this came down 4%, which means that the 10-year expectations of inflation actually did come down in the last week, which is pretty good. Mr. Beast, I see your recommendations, man. We'll take a look at those once we're done talking about some of the stuff we're talking about. Mention it when it comes time to talk about tickers. We're not talking about tickers right now, but maybe we'll take a look at those when we get there. And besides, isn't that the bank that's like going under right now? Isn't NYCB the bank that's like literally going under right now? I'm not sure. I'm not sure I want to. Maybe I'm wrong about that, but isn't that thing like dying? Why would I want to go look at that? I feel like that's literally the last thing I would want to go look at right now. Yeah, it might be cheap. It might be a lot cheaper than it was before, but I'm not sure that's a good thing. Yeah, time to buy. I don't know, man. I like to buy companies that are going to do good. We'll see. I'll take a look at it. I haven't ever actually looked at it. This opinion is me talking based off of what other people have been saying. So, I don't really know, but I don't know. I don't just go buying things just because they're down, Best of luck to you. Like I said, we'll take a look at it in a little bit. Just hang around and let me finish talking about the economic stuff, and then we'll go talk about it. So we can see oil's coming up a lot this week. That's pretty interesting to see, especially since the markets themselves did pretty good this week. Both the S&P and the Russell were up this week. So oil markets were up. 10-year treasuries were up, though inflation expectations were down within that, and the dollar was overall flat. So we would almost expect the market to have been down given those dynamics. Maybe it will reverse in the next week. It's hard to say. If we come down here to the sectors, there's actually pretty muted overall within the sectors. So you can see it's like there's not like huge standouts within the sectors. There's a couple downers like utilities and defensives in the small caps, but a lot of them are also just kind of in this kind of 0 to 1% to 2% kind of range in terms of the upsides. So not a huge lot of movements in terms of all that. Come over to the macro page. You can see the stuff that I've added to this. Previously, when I last showed you guys this, we had the inflation boxes here, and then we had the growth as well as the leading indicators for growth. I had put those pieces in here, I think, previously, but so you can see I've added the money supply page up here, or 2 tabs for the money supply. We have the M2 stock in the United States right here, as well as what I'm labeling the AMS, which is the Austrian money supply. I'll talk about that in a second, but it's, in my opinion, a better measure of the actual money supply within the economy. I think what is known as M2 money stock is really more of a measure of liquidity, not an actual measure of money. What is the difference between money and liquidity? It's a whole complicated topic that I'm not really going to get into right now. But the point is M2 includes money, but it also includes other things that I think technically are more like investments, just very, very liquid investments, more than they are an actual money. So AMS, I think, is a better measure of money, and you'll see why that matters when I go and show you the charts for those ones in a minute. But the point is, we do want to pay attention to both of them. You can see they're both down significantly over the last year. AMS is down much more than the M2, and that's a sign of the money tightening that we've been going through. And I think that's one of the reasons, for example, why you can see that this is a better measure. It's much more volatile, and that volatility goes in pace with the economy, and that's what you would want from a good money stock measure, is something that is a good gauge of the economy. And then we also have the Federal Reserve assets, the Federal Reserve balance sheet we pay attention to here. That's another thing that we is a gauge of the money tightening. You can see it's coming down over the last year. Now for the Federal Reserve balance sheet, you'll see that I have the downward movement marked as green. You could argue about whether you want that to be green or red, because most investors would consider the Fed assets coming down to be a bad thing, since that's a downward movement in liquidity. And so they say that that's going to be bad for markets. But I think it's actually good for markets in the long run that the Fed doesn't have a giant balance sheet, because that means they have less impact on the market, which means that they can marginally increase their impact on the market to a greater degree. So that basically the Fed's tools work better in my opinion, when their balance sheet is already small and they're trying to make it get bigger, rather than when they already have a big balance sheet and they're trying to make it even bigger than that. It lessens the effect. So in my opinion, the balance sheet coming down is a good thing. So that's why it's marked green here, even though technically it moves counter to the money supply effect itself. Now, anyway, we already talked about the inflation stuff last week, so I won't talk about that stuff again. We talked about the growth stuff again. I won't talk about that stuff again. The composite leading indicators and the consumer confidence and the business confidence stuff, which I talked about. I talked about how these measures, they supply these data sets for other countries as well, not just the United States. Basically, a large amount of the major economies globally have these measures, and I am compiling a lot of those data sets for a lot of the other major economies globally. So I am looking to add a whole lot of economic data to this page for a lot of global economies as well. So you'll probably see that in future weeks. But then down here, I added this employment section, which I think is pretty useful stuff for gauging what's going on in the economy, right? We need to know what's going on with employment. So we have the headline unemployment figure right here. You can see it's currently is 6.1%, and that's the January measure. So likewise with the other measures right here, we have a thing that tells you basically when did the most recent report come in, because some of these measures come in a month later than other ones, and so you want to know what specific piece of data you're looking at for each one of these. You don't want to be kind of blind to what this number specifically applies to. Was it for December, or was it for November, is it for January? You want to be super specific of which month you're talking about. But anyway, yeah, so unemployment in January was reported at 6.1%. We have what it was reported a month before that, also 6.1%, but technically it's a little bit lower right now than it was in the month prior to that, about 0.5% less than that. And then what it was 3 months ago, also what it was a year ago. So you can see overall, unemployment has actually been coming down over the last year, not by a lot, but by 3% in the last year, unemployment has come down. Prime unparticipation, this is kind of my own definition of calling it this. Basically what I take the labor participation rate and I invert it. I say 1 minus the labor participation rate, because participation says how many people are participating in labor. Unparticipation says how many people aren't participating in labor. So it makes it a measure that's closer to unemployment by essentially taking 1 minus labor participation. And then prime, what I mean by prime is that this actually is only the participation of 25-year-olds to 54-year-olds. So it's narrowing in on the prime working years, the section of the lifespan where you would expect the vast majority of people to be working. So this prime unparticipation, in my opinion, is like a unaffected version of the unemployment number. It's like saying, what would unemployment be if the government wasn't massaging the numbers and trying to decide who is looking for work and who isn't looking for work? Because that's how unemployment works. Unemployment only counts the people who are looking for work and says, oh well, if other people are happy to not be working, let's not count them, because there's no problem there, right? Which is true to a certain extent. I'm not saying that those things aren't true. I'm just saying that it's only half true. So sometimes you want to be a little bit careful about relying on the reported unemployment number. And so my way of making sure that I know what's really going on is by paying attention to the prime unparticipation number, which you can see this number has come down over the last year as well. It went from 17.3% a year ago to 16.7% as of January. So overall, employment's doing pretty good, it looks like. Now we have these kind of more leading indicators on employment down here. We have the continuing claims, which continuing claims essentially people who have not only made an initial claim on unemployment, but are continuing to do it in follow-up weeks and months. And then it's the 4-week moving average of that. So we've smoothed out the claims measure to really look. It's like, how is the continuing claims really starting to accelerate? Is the claim numbers on unemployment really starting to accelerate? Are these people really starting to become unemployed in a more permanent sense, or permanent in the midterm? I just mean, like, have they gone from being unemployed for like 1 month to now being unemployed for like 6 months, right? That's you're trying to capture the difference there, because a lot of people become unemployed, but a lot of people are unemployed for a very short period of time, and it almost doesn't matter for those people, right? You want to know about the people who are starting to be unemployed for a while, and that's the thing that really matters. So this helps us to track when that movement is starting to happen. You can see when this number moves up, it's not good, and it has moved up 23% in the last year. However, we were at a very low level, it's worth noting, about 0.5% of the US population. That's what this percentages is as a percentage of the population. So it went from 0.5% to 0.6%. It's a relatively low number. And in the data sets I show what the averages are. We're still at like half or something like that of what the average level is. So it's still currently no problem. Then we have openings as a percentage of population. What are the job openings as a percentage of the population? We went from 3.4% to 2.7%. So job openings have been coming down. And that is a leading indicator of recessions when the job openings start to disappear. So this going up and this going down is a leading indicator that these numbers might start to change. And then likewise, hirings as a percentage of population, also a leading indicator. This number has also come down from 1.9% to 1.7%. So also not good. And then quits as a percentage of employment. It's as a percentage of employment because that's how it's reported rather than as a percentage of population. So it's worth noting that this percentage isn't exactly the same as this percentage, but either way, we're using percentages because that's a population scaled number. And it went from 2.6% down to 2.2%. So this one is also coming down. So our leading indicators of employment are all flashing red on a year-over-year basis. They're a little bit better in the last month, but on a year-over-year basis and on a 3-month basis, they're all getting worse, which means we should maybe start to see these numbers get worse over time as well. And if these numbers get worse, these numbers start to get worse. So you can start to see why we have all of this data here, why we're tracking this information. It's like this information helps us to see what's going on in the economy as a whole. So anyway, I did want to take a quick look at some of the other details related to some of these data sets. We have the links that take us to all the charts I put together here. Here I have, for example, here you can see the actual Federal Reserve balance sheet. This is the blue line is the Federal Reserve balance sheet. My bad. The blue line is the Federal Reserve balance sheet in nominal terms. The yellow line is the Federal Reserve balance sheet inflation adjusted. I have inflation adjusted there because it's something you might want to track. And then we have the 3-year COGR for each of these as well. For the red being the normal balance sheet, and then the green being the inflation adjusted balance sheet. So just kind of tracking the overall changes. You can see back before 2008, and then we had a huge jump up in the balance sheet when they were responding to the crisis. Then also responding to further crisis in 2012 and 2013 with the Eurozone crisis. Then they leveled off in 2015, 2016. They started bringing the balance sheet down, bringing it down even more in 2018, 2019. That's when we started to reach problems, which those problems were conveniently masked by the COVID-19 pandemic, because a lot of people were aware that we were probably going to go into recession in 2020 anyway. But COVID happened. So it's just kind of an interesting thing that recession got masked essentially. And it was almost like a convenient a way for them to dump a lot of liquidity on the market and save the economy from that problem by using COVID as their backdrop. But anyway, you can see jump up in the assets right there. And then we reached the peak level in 2022 before they start bringing the assets down significantly. So it's pretty interesting to see that, we peaked at almost 9 trillion in assets on the Federal Reserve balance sheet, and we're down now to almost 7.5 trillion. So pretty interesting. What is that? That's like 15, almost 20% or something like that over a 1.5 year period. Pretty significant downward movement in the balance sheet. I personally think that they should be trying to get the balance sheet much lower than that. I feel like honestly we should be trying to get back to where we were in like the 2015 2016 region. Like I feel I've kind of run some numbers based off of like average levels of balance sheet relative to money supply versus GDP in like the past decades. I have kind of like tried to run some numbers on this a little bit, and the number I came up to was like between like 4 and 5 trillion. In my mind, seemed like an appropriate number given our size of our economy currently. But again, some spitball estimates based off of historic data. It wasn't some super detailed analysis. But yeah, my napkin math told me that the central bank balance sheet should probably be getting back down to around here or something like that. So in my opinion, we still have a long ways to go. But I've heard rumblings from the Federal Reserve people that it sounds like maybe they think that they've reached the end already, and maybe they'll stop at like 7 trillion or something, which I don't know, whatever. That is what it is. Anyway, so we can come over to the other charts. Here is the money supply. Now, I was talking before about the 2 different measures of the money supply. Here I have those 2 different measures. The yellow area on the backdrop is the M2 supply, the normal M2 as most people talk about it. And then we have the Austrian money supply here in the green. Or wait a minute, hold on, double check. Let me double check actually real quick that I have. I'm looking at those and now I'm actually like questioning if I put the thing I thought I did here. Oh yeah, okay, never mind. Yeah, I second guessed myself when I was looking at this. I was like, wait a minute, this doesn't look like the chart of the M2 versus the Austrian money supply. This is the chart of the M2 versus the inflation adjusted M2. So yeah, this is the inflation adjusted M2. in the green. My bad. I thought I had the chart of the Austrian money supply up here, but oh well. I guess I forgot to put that one together. I'll have to share that some other time. But anyway, yeah. Either way, you can see the huge differences. The money supply peaked at around 24 trillion in 2022, and it's currently now down to around 21 trillion. So that's like a 12 to 15% drop in the total money supply, which is pretty interesting considering in the M2 money supply, we don't see it go down on a year-over-year basis very often. See, here's the 0 line, and the yellow is where it goes negative. So last time we saw it go negative on a 3-year basis, because this is the 3-year COGR, was back in the early 90s is the last time we saw that happen. And then in the early 80s, we saw that happen. And then it barely happened in the mid 70s, just for a little brief period. Again, 3-year COGR. So that means it would have been technically negative for like 2 years at that point before it to happen. But the point is, only a few times in the past has the 3-year COGR become negative at all. And then here we are currently at a negative 2% 3-year trailing COGR. In inflation adjusted terms, we could say likewise, the inflation adjusted curve has only gone negative once, twice, 3 times, 4 times, 5 times, 6 times, though more significantly 6 times, because inflation adjusted terms makes a big difference there. And then also during the great inflation period where they hiked up interest rates, you can see that it went massively negative by a 3-year COGR all the way up to a peak level of negative 14%, which is pretty crazy. It's currently down at negative 6% under those cases. Now, I did all the employment stuff. Unfortunately, I don't have charts for the employment stuff. I wish I did, because I could kind of show you. And I'm pretty sure I've shown you guys this stuff before. Hires, Fred. Let me go. I showed you guys these charts before when I was talking about leading indicators. How you can see is like when you're going into recession, these numbers start to come down. And then you can also scale it, obviously, against population. Ariane, what's up? InMode and Disney popping. Yeah, they've definitely been moving. Disney had some pretty spectacular earnings, much better than a lot of people were thinking. And then InMode itself is doing pretty good. We'll have to see how well they do on their earnings, of course. Thoughts about PayPal? I was talking about PayPal a little bit earlier. You might have to go back a little bit if you want to listen to some of the thoughts on that. But or wait a minute. Actually, no, never mind. I didn't actually get around to the PayPal stuff yet. My bad. I talked about almost everything but PayPal so far. My bad. I was talking about the other companies, and so I kind of forgot about that. But I kind of switched after talking about the Mosaic thoughts and Alibaba thoughts. That's right. I was talking about Alibaba. So give me a moment, and we'll talk about some PayPal thoughts at some point. I just want to get through the economic stuff a little bit. So anyway, you can see how the hires as a percentage of population start dropping prior to the actual recession bars. So it's a little bit of a leading indicator in that sense. And then you can do the same thing with quits, as well as openings. Openings, spread. I won't bother using the percentage of population. It still shows the pretty well. Openings starting to fall prior to the recession actually reaching its point there. Quits. Gravity Co has negative capital employed, also trading cheap. Have I looked at Gravity Co before? I think I have. Quits also start to fall when you're going into recession. Just definitely want to pay attention to those things. All right, so that's enough with talking about all the new indicators, like I said, that I've added to the dashboard. We're going to be expanding the economic data that we have on this little dashboard piece here in the weeks and months going forward quite a bit. But one other piece of economic data I did want to talk about in particular, something that people have been kind of making waves in the economic news a lot, is the rise in the container rates, the freight rates. Global freight rates in general have been going up pretty dramatically. Here, obviously, this is the freight rate peaks that we got in 2021, 2022, so we're nowhere near those peak levels. But in general, you can see the averages that we had back in 2018, 2019, it was in this like $1,500 range in terms of at least this particular index right here for several years. And then we did reach back all the way down to those levels, if not even possibly some lower levels, close to 1,000 for several months here in 2023. Let's zoom in maybe on the most recent year. So you can see like 1500, we were kind of back to that like 1500 very, very happy level right here. And then here, just in the last couple of months, since all the conflicts in the Middle East have started spiking up, it's risen dramatically all the way back up to the 3300 kind of level. Now I bring this up, I wanted to find some articles talking about it, but there was some research that I saw a lot of people doing last year or in 2022 as well, talking about essentially the ways in which the container rates affect the global shipping costs for the goods inflation. And I saw estimates basically saying that every time this rate doubled, it essentially increased the global inflation rate by about 0.7%. Due to the way in which it affects the goods produced and the cost of those goods being sent globally. So each doubling, so that's kind of like a logarithmic scale. So you kind of have to take that into account. Like back when we were at 1500, that means up to 3000 would be a doubling. And then from 3000 to 6000 would be a second doubling. And then from 6000 up to 12,000 would be a third doubling. So back in 2021, we got almost up to 3 doublings. It reached about 11,000 there, which is almost to a full 3 doublings. Which means that you would have gotten 2.1% added to global inflation based on that. I don't remember what the global inflation actually ended up peaking. Maybe I can find that real quick. What was the year-over-year rate peak? Around 8%. So around 8%, they're saying that at least a quarter of that could have been arguably contributed just based off of the freight rates moving up due to all of the conflicts that were disrupting global shipping during 2021, 2022. Again, that's what we experienced back then. So coming back into where we are currently, obviously we did get back down to that 1500 level, and arguably you could even say that for the months between September and December, we were even closer to like 1,000 to 1,200. So you could argue that too, but maybe we even just say, let's say 1,200. Let's say 1,200 is essentially where you're at. Well, then what doublings have we had since then? Up to 2,400 would be a doubling, and then up to 3,600 would be a second doubling. So we're not quite there, but more than 1.5 doublings, close to 2 doublings, 1.5 to 2 doublings, depending on where you say the base point is. So 1.5 to 2 doublings, that would make it assume that we would possibly get, what is that, like 1.2 to 1.5% in global inflation potentially rising. So point is I'm bringing this up because this takes time for this stuff to actually start cycling into inflation. So unless a lot of the conflicts in the Middle East start to unwind themselves very, very quickly and this rates start to come back down, the longer these rates stay up here, the more likely it is that some inflation, particularly in goods inflation globally, is going to start spiking again. Now, I say globally, which countries are going to experience which levels of it is going to vary dramatically. This is the global level we're talking about. So it's possible that Europe won't experience it at all, while North America will experience a lot of it, or vice versa. I'm just throwing some numbers out there, but that's something that to keep in mind, is that there's definitely a lot of risks to inflation due to the conflicts going on in the Middle East currently. So I just kind of wanted to bring that up a little bit. Come up to some of the comments you made there. In economics, how do you know what small changes will lead to system level changes? Well, you don't really. You don't. Economics is a very, very complicated thing where everything is affecting everything. So when they're talking about, like, for example, in that study that I was reading where it was saying, we think for every doubling of container rates, it leads to this much inflation. The common thing in economics is to, what is it? Cerebus paribus. I can't remember the Latin term of it, but there's this Latin term that means all else held equal. And generally, when you're doing economics, you're working under those assumptions. You're basically saying, well, if I hold all the other factors equal and we assume that nothing else changes, and if we just change this one thing, how does it affect the results? But in reality, everything's changing all at once. So it can be very, very difficult to decipher how things are going to spill out into overall major effects. Now, because you might be looking at like that rate I was just looking at, you might be saying, well, why is that going to affect things so dramatically? Well, all I would say is that the Suez Canal, where all of these conflicts happen, go take a look at like what percentage of global shipping goes through the Suez Canal, and then take a look at the time difference as well as the cost differences that are created by ships having to go all the way around Africa rather than the Suez Canal. And that's where essentially the rational basis for why you would get the results that I'm talking about. So it's like, yeah, it's possible that there are other factors, for example, that could cause more disinflation that would essentially balance this out. And we don't really know for a fact, like if it's possible that the overall level of global inflation won't actually seem to go up because there's so much disinflation already baked in that it essentially just counteracts the two. But we don't really know that. So all I'm saying is that I think that the risks are further to the upside. But of course, that assumes all else held equal, and nothing is ever actually held equal. So anyway, we'll move on from that. We'll talk a bit about some PayPal. I'm not really going to go and get into all the nitty gritty of their earnings presentations. I will say I'll talk a little bit about some of the details related to it. There was a further drop in the active users, about another 1% drop of the active users on the quarter-over-quarter basis. And I'll remind people, as I did with the last earnings call, that doesn't mean that people stopped using PayPal in like a sense where they had the app on their phone and then they went and took it off the phone and they're just like, I don't like PayPal anymore. Let's not talk about PayPal. Let's not have that PayPal. We don't want to be PayPal customers more. That's not really what happened, because they count their active customers based off of a trailing usage basis. So essentially that just means people stopped using PayPal, not that they went and canceled their account altogether. Mr. Beast, how PayPal before talking about New York City Bank? Because PayPal was already on the agenda to talk to. It's in the thumbnail, my dude. That's why. I was going to talk about PayPal before you ever showed up to the stream. It was already on the agenda to talk about PayPal. That's why. We will get to the tickers right after we finish talking about PayPal. That's literally the last thing we're going to do. So don't worry, man. We'll get to it. But yeah, so there's a big negative reaction in PayPal stock, partially as a result of the drop in the users. But one thing that I had said in the last earnings call that I was looking forward to in this particular earnings call is the fact that this is the annual report, which means that they give a little bit more detail in the 10K, including their merchant accounts. And I specifically said that I was going to be watching the merchant accounts, and that if I saw the merchant accounts going down, that was going to be a major red flag for me. And that I was actually going to be looking for the merchant accounts to be going up. Unfortunately, the merchant accounts didn't actually go up on a year-over-year basis in the 10K, but they didn't go down either. So that puts me in at least a middling period where I'm at least happy that it shows me that they're not losing ground in the area where I think that they hold their competitive advantage, because I think PayPal holds a competitive advantage in terms of the merchant experience with them, even more so than the user experience. The user experience is important because it's how they are going to grow overall. But I don't think that that's necessarily the thing where they have their advantage. I think they have an advantage with the how easy it is for merchants to use them and how much of a preferred partner they are for merchants in particular. So seeing that they at least held the line there was important to me and important to my overall thesis for PayPal. Now they did have a further increase in the transaction costs that they have, and the credit spread costs, or the combined level of those two, and the way that gives their net spread relative to their transaction volume, which is another thing that people have been very negative on. But they were able to lower other costs that they had with their other administrative costs, so that on a year-over-year basis, their costs actually in general were a bit better. So yes, their costs were squeezed in some senses, but they were also improving in other senses, and enough that I'm essentially reasonably pleased with it. I know it might seem like almost a little bit of a cop out, considering it's essentially sort of the same answer I gave last quarter, but I'm essentially willing to consider this part of the transition. I'm willing to kind of say, okay, they're at least holding the line. I understand that this is the new CEO, and they have to kind of reorganize things before the growth is going to actually reaccelerate. I wish that the CEO had not come out in that presentation and made a big deal on it and said, "Oh, we're going to shock the world" and all that. That was the one thing I didn't like, because in my opinion, he set the stock up to fail based off of expectations. So if we come over here to, for example, my model, I've tweaked a few things within here. Other things we'll talk about. So like I was saying before, they held the line in the merchant accounts. My assumptions for 2032 assumes that they're going to increase their merchant accounts on average, but not by a lot over the next 10 years. So the fact that they didn't grow any this year doesn't really affect anything too much, because they have a lot of time to do that growing. I do expect them to grow their user counts a bit on average over the next 10 years, but not a crazy amount comparative to their history. So the fact that that came down a little bit isn't a deal breaker either, but it's a much smaller portion of my evaluation than my assumptions about the transactions per customer, as well as the dollars per transaction. And both of those figures did great this year. They went from 51 transactions per account in 2022 to 58, almost 59 transactions per account in 2023. On average for my DCF assumptions here, I have it going up to 90 over the next 10 years. So you know, they're doing pretty good. They're making plenty enough progress in terms of that for me to be happy. Then there's the dollars per transaction. They had about $61 per transaction in 2022. It's still about $61 in 2023, but it's actually solidly over 61 rather than less than 61. So there is upward movement there. And my average assumption for my DCF only needs them to get to $63, $64 per share in 2032. And that would include inflation in that number. So really it could all just be off of the back of inflation. So essentially just showing you that the active users was a bit of a letdown, but they did better than I expected in terms of transactions and their dollars per transaction. And they also did better than I expected in terms of the dollars per account of value add revenue as well. So their other forms of revenue did better than I expected as well. So in general, yes, active users, not good. We really hope to see that improve. But every other part of the revenue story from my perspective did pretty good. And so that's why I feel pretty okay with that. Now getting to those other factors I was talking about, we have here the transaction expense as a percentage of volume. It went from 0.9 to 0.94. Every basis point is a big deal there. So that is a big deal. And especially since in my model here, I have it actually going down. You know, that's not good. We'll definitely have to rethink that. I have it going down, but that's in terms of where the transaction volume goes. I actually scaled it based off of per transaction, and the per transaction level, I have it going from 54 to 58 cents. And then that I also have on average at about 53. So that also needs to go down. So, but that's by a smaller margin. So the point is I do need to adjust my assumptions in terms of the transaction costs. They did pretty good as far as my expectation goes in terms of the credit losses, however. And then, like I said, they did better than I expected in terms of the operational costs, marketing costs, general costs, and all of that. So overall, between the sets of costs, it was about as good as I expected on a wash. But I do think that in the long term, the transaction costs and the credit costs are a little bit more important. So I did need to bring down my assumptions in terms of that as well. And then if we come over to the actual DCF template and take a look at the stuff that went on in there, taking a look at the revenue growth paths, as you can see right here, my expected revenues 10 years from now, I'm assuming for the next 10 years that they're going to grow about 5% overall. And then really that's on an interquartile basis, anywhere between 1.5% and 8.3% cumulative growth cases over the next 10 years, you can see right here. So in general, we're assuming that they're going to get to about 50 billion in revenues in 2033, and that's relative to their current 30 billion. So that's what we're assuming they're going to do in terms of revenues. They had 26% as an operating margin. That's R&D capitalization adjusted R&D operating margins. It's worth noting. So it's probably a little bit higher than the reported GAAP number, but 26% was what we had in 2023. Over the next 5 years, I'm assuming that that's going to be actually closer to 20%. And then over the 5 years to follow that, we're assuming it's going to drop closer to 17%, and then it'll end at about 18%. So you can see that my assumptions are that the margins are going to continue to come down. I'm having their margins essentially slowly get squeezed down over time. And that's consistent with the story as I just painted it. Operating income, R&D adjusted in 10-year forward period is anywhere between 5 and 10 billion. It looks like the majority of outcomes end up being. And then in capital expenditures, in general, we're assuming that they're going to have a decent amount of capital expenditures up front and decent amount of capital expenditures in the terminal years, but they'll probably have some years there in the middle where they actually have relatively low reinvestment and are probably a cash flow machine somewhere in the middle of there. So you can see how that plays out right here. That gets us to free cash flow levels of between 3 billion and 8 billion. Looks like the majority of outcomes end up. So a pretty wide range of how big the free cash flows could be in the terminal level. On average, we're seeing about 4.6, 4.7 billion. That's relative to the 2.6, 2.7 that they had in 2023. And it's worth noting that my free cash flows here are adjusted for stock-based compensation. So when you're looking at this free cash flow number, it includes, I should say, it has the stock-based compensation already taken out of it. We've already subtracted that number. So that this is real free cash flows, real actual cash flows that are coming back to the business on a per share basis, effectively speaking. Then one other factor that on my previous valuation, I've had multiple people comment on was my terminal multiple. I previously had it around like a 19. I think it was like 19 and a half actually even. So some people argued that my PayPal multiple was a little rich for them, which I definitely wasn't disarguing with that, but I thought I was being even more conservative in other areas. So I've kind of rebalanced the conservatism across these different sets of assumptions. And now the terminal multiple is more like 17, I believe it was, right? Yeah, 17.7 is now the terminal multiple that I have on PayPal. So that gets us to this distribution. Interquartile range between about $47 per share and $87 per share. Median about $70 per share, expected value about $68 per share, fair value distribution, as you can see right here. So some decently bunched up possibilities of it being much lower in like the $40 range, or possibly even lower than that. But the majority of our outcomes are more like in the $60, $70 range, possibly even higher 80s, 90s, and something like that, with some potential for it to be much, much higher. So this is where we are with the PayPal valuation. Like I said, didn't really want to get into their presentation and get all the nitty gritty of like actually what would happen in the year. I just kind of wanted to show you guys how I've updated my valuation. So we did bring it down a little bit. I can't remember exactly where it was before I started all the updating, but I think it was like around 75 or something. So I do believe we did pull it down a little bit, but not necessarily a ton. And then that also, of course, takes into account the other changes over the course of the year: cash balances, investments, share count change as well. They are buying back and all that. So that's it. Aryan Bartel, how is your fair value distribution bimodal and not normal? Because I decided the probabilities myself. That's how. Because what he's talking about is this distribution right here. What he means is that if you have two peaks within a distribution, it looks like there's two most common answers, because that's what the mode is. The mode is the single most common answer. So the single highest bar right here would be considered the modal outcome. The modal outcome would be about $91 per share, and then the second modal outcome would be $84 per share. And you could argue that these are so close to each other that they're effectively they're both the mode. And so that would be what he's referring to as a bimodal distribution. This is sort of what you would call a bimodal distribution. The reason why it looks like this is because of the assumptions I put into these probabilities. Like, I'm just making up these probabilities when I make these valuations. So like, I have a bull case, a base case, and a bear case for my revenue growth, my margin assumptions, my capital expenditure assumptions, my discount rate assumptions, as well as my terminal growth assumptions. So 5 different variables that I make up the probabilities for. I completely make it up. There's no special magical trick to doing this. I just make it up. I start, for the record, with with 60 in the center and 20 on the edges. That's kind of how my default is, something close to a normal distribution, because that's close to a normal distribution, and then I tweak it from there. And it's worth noting that the way this spreadsheet is put together, it actually does not work if you put something less than 20% in there. So that's the minimum that any of these boxes has to have. It has to have at least 20% in one of those boxes, but I could put 25%, I could put 30%, I could put all the way up to 50% or even 60% in one of them, right? As long as the other two are 20%, right? So anywhere between 20 and 60% in one of these boxes, as long as all 3 boxes add up to 100%. That's how these probabilities work. But you can see, like, for the revenue ones, I tilted it a little bit more towards the bearish revenues, but only by 5% did I tilt it there. And then in the margin ones, I tilted 30% towards the lower range of the bearish outcomes. And then in the capital expenditures, I did also 30% on the more bearish range of outcomes there. And then on the discount rate assumptions, we were actually a little bit more optimistic on the discount rate. And then we were even on the terminal growth. So you can see that the majority of these, I'm slightly tilted towards bearish. I'm a little bit bearish on the revenues. I'm significantly more tilted towards bearishness on the margins, and significantly so on the capital expenditures as well. So all of that tilting towards the bearishness side is going to pull that distribution further to the south. Okay. So do you see how it becomes bimodal, essentially, with those, by putting those extra percentages in there? His follow-up question: how do you do a what if analysis with your probabilities? I have only been able to do it with normal norm.inv function in Excel. The normal.inv is a normal distribution in interval function that he's talking about within Excel. I mean, that's a tool for actually using a real normal distribution. So like that function, what that does is that allows you to apply an actual normal distribution to things, but that's not what I'm doing here. Like I'm building a distribution, but I'm not like telling it to specifically make a normal distribution. Like I said, like I'm allowing myself to do whatever I want with the distribution, based off of whatever my assumptions are. So like I said, I start with a normal distribution, but if I think that tilting towards a bimodal makes more sense for something, I can do that. Like I could theoretically put 40% in the bull case and 40% in the bear case, and then only 20% in the base case, right? So I could literally put bimodal in a single variable if I wanted to, or I could put 50% on the bear case and 30% on the base case and 20% on the bull case. So that would be like that would almost be like a logarithmic or an asymptotal kind of distribution, right? You can kind of play with these distributions and do whatever you want with it. But as I said, it's totally made up. From my perspective, it suits whatever my needs are. So like if I feel more confident at one end of the margin scale, but I want to include a little bit of some outcomes where there are some worst case scenarios are really, really bad, or some best case scenarios are really, really good, well, then this is the tool in which I can do that. But yeah, I'm not actually relying on the actual statistical normal distribution. I'm just creating a distribution based off of kind of my own subjective views about bull, base, or bear cases. And then, the assumptions that I put within those bull, base, or bear cases are usually a little bit more, methodical, right? The models that I build are, usually how I come up with those things. But the actual probabilities that go in there, I mean, they're totally made up. They're totally just me kind of putting my own feelings about it in there. And that's kind of what it's supposed to do. It's supposed to try to capture as much of my feelings about the stock as possible. So like if you look at this distribution right here, what it tells you is it shows you that I see lots of situations in which PayPal could do pretty poorly, both in revenue terms and in margin terms and in terms of its reinvestment levels. And so because of all of those potential headwinds, we see lots of potential negative downside for the stock. But because it has significant revenue upside as well, and there's some circumstances where those margins really do stick out into the terminal case, and there's some circumstances where they have much lower investment needs, that you can end up with some much higher level outcomes. And then the average of all these outcomes ends up being what the actual fair value is. So, it's like really it's just one number, 6841, right? 6841 is the one number. But that one number is also all 1,000 of all of these numbers. And so really it's just kind of looking at the disbursement of it that allows me to think about the stock better. There's not like, some special magic to like the actual distribution that I applied to it. But yeah, good questions though. Very, very useful questions. I know it's very tricky to build your own tools in Excel as it sounds like you're trying to do for it. All I can say is kind of experiment with the functions a bit until you find something that kind of works for you. All right, so that's all of that on PayPal. We'll stop talking about PayPal. Yes, Mr. Beast, we can finally talk about some of the other stuff. Hold on a second here. I need to Gravity Code. I think he was bringing up that one as well. No, computer's getting mad at me. Hopefully Mr. Beast is still listening. And hopefully all of you out there watching live or on the replay will give us a like if you're enjoying the content. And subscribe to the channel if you're not already. And join the Discord if you're not already. And consider donating to the channel with the PayPal link if for some reason you feel like supporting us. Yeah, we'll take a look at Gravity Co. after I do this one first. I promised him I would look at this one. So anyway, obviously everyone's been talking about all the movement in it, going from kind of this 10 $9 to $11 range or something like that, now down to half that in a very, very short period of time. You know, when did it happen? End of January was when it happened. Looking back over the last 5-10 years, peak levels at like 2015, 2016, $18 per share. So it looks like it was already, you know, significantly struggling. It hasn't been participating in all of the bull markets in the last few years at all whatsoever. Obviously, it has a very, very high dividend yield, although that's off its current price of 14%. So if it was twice that before, that means it would have been like 7% prior to that. But that's still a 7% headwind to get over for capital appreciation. You have to keep that in mind, that whatever the yield is, it's subtracting that percentage, effectively speaking, from the market cap every year in order to pay that dividend to you. So essentially, the expected returns of NYCB would have to be 10% in order for you to have 3% capital appreciation a year if you're having a 7% dividend. All right, like that's the basic math, effectively speaking. So the fact that we see ever since 2016, it's just been coming down and down and down. It looks like the high dividend yield and a lack of growth, it would highly explain that. So let's take a look at the estimates. I know a lot of the reasons why it's currently in trouble is partially because of, from what I was reading, it's like it has a huge exposures in the commercial real estate. So all of the concerns related to the rollovers of debt in commercial real estate and the concerns that's creating is, I believe, largely the reason why it's seeing such a major downside. So it's expecting to have a 42% drop in revenues this year. The revenues, when it comes to looking at banks, however, for these estimates, sometimes it includes all of the revenues and sometimes it only includes other service revenues and not the interest revenues. So it's sometimes you kind of have to look closely to see whether that includes all of the revenues or not. Take a look here. 5.5 billion is what we had in 2023, and they were okay. It looks like the revenue expectation they have here does maybe include the full number. So yeah, if they're expecting that, that's gonna be a huge drop, and then a little bit of recovery in 2025. The margins prior to that, or the margins that they're expecting, is gonna be 27% and then 31% prior to that. Let's go look at net income margins because it is a financial. So 15 to 16%, 18 to 19%, which is pretty decent for a bank. Not super atypical. Let's take a look at them. So in general, they've had pretty strong net margins. So that would actually be a significant drop in their net margins on that kind of basis. But how they're normalizing it can also be a question when you're looking at these websites. So you often have to look a little bit closer. Return on assets, basically almost nothing, which is also pretty typical for a lot of financials, but we still kind of hope to see at least a couple of percentage points there. Return on equity, you do hope to see a little bit better. That's not so hot either. Let's take a few of these off now. Looks like the return on equity would probably have difficulty making it over the hurdle rate, except for the most recent year. It looks like it increased, but historically not looking the greatest. So let's come back over to the balance sheet. What's going on here? So they got 84 billion in loans out of 116 billion in total assets. $11 billion in cash, investment securities, 9 billion. $1 billion in deposits. So they have more loans than deposits. And then they have net debt beyond that of like 10 billion or something like that. In the ballpark of around the levels of what their total equity levels are like as well. So, I mean, in terms of their balance sheet definitely doesn't look super ugly on this basis. I'd have to see how, if the most recent changes in the most recent earnings changed or anything like that. But it looks like, you know, if we were to assume that everything was performing well, this wouldn't be bad. But I think that part of the issue is the concerns about these loans and a chunk of them perhaps not performing well. And I haven't really looked at their financials to really see about that, but they don't have a whole lot of room for those the assets to not be good. It's like everything looks nice assuming all the assets are worth what they say they are, but that's the problem. So now remember back here is where they were at the kind of like the peak levels in terms of their stock price. So they were trading at like 13, 15 back then, and that's prior to interest rate adjustments as well. So I mean, the multiple they were trading at prior to the big drop they've had here now, they were at more like 6 to 8, which you could argue that alone could have been just like interest rate adjustment in and of itself. So if they're going to have their revenues drop by half as much, you would expect them to be trading at like a 3 or 4. And they're currently trading at like, well, depending on which multiple you're looking at, if we average between these two multiples, it would be like 4. So, I mean, you know, I don't know. I wouldn't necessarily, they don't necessarily look like they're too expensive in terms of the amount of decline that they've had relative to the headwinds we're talking about. I haven't looked at their assets closely in their filings, right? Like I said, so it's like it comes down to like what level of underperformance we're talking about here. If 10% of their loans are underperforming, I think that, you know, they might be fairly valued still under those circumstances, but they probably wouldn't be a great value under those circumstances. If it's like 20% of their loans are underperforming, this thing's probably toileted. This thing's probably garbage. But if close to all of their loans are performing, well, then this thing probably is a doubler, right? So it's like, you know, it all comes down to that. And I'm probably not going to go looking into their filings to really like actually look at their assets or anything like that. So like I said, just me looking here on Ticker, I would say it's like, it looks like it could probably be fairly valued, and maybe even have upside depending on the level of performance. But yeah, I don't know, Mr. Beast. I would personally would be looking at less risky situations, because I don't know, maybe you've already looked into some of their filings and maybe you already feel pretty comfortable with their assets. But unless I thought basically all of their loans were pretty good, with like, you know, no more than maybe like 5% or something of them not likely to return, then I would be skeptical of the value here. But like I said, under circumstances where they actually outperform a lot of the worries, this could be a banger. It definitely could. So that is what it is. So Gravity Co. You want to take a look real quick at Gravity Co. And then we'll maybe call it a day at that point. Good old Gravity Co. I remember I never really looked into this one too much. I remember it kept coming up on a lot of screens and stuff. I don't really like a lot of these like online gamer ones. I always feel like these things are just like too fad driven or whatever. I don't know. It makes me feel less confident in their ability to maintain themselves, but it looks like they do have a decent amount of games. I don't know. Maybe they've got decent diversification across different gaming groups. So hard to say. I know you were bringing up their negative capital levels. So let me go and investigate that. I will say, you know, on one hand, it's nice to see a company that has negative capital, because that implies that they're a super capital light business or a capital efficient business. But at the same time, it kind of makes analyzing them a bit of a pain, because I like to rely on the return on invested capital number as like a super strong gauge of like the quality of a business. So it makes it impossible to use that measure. So it kind of sucks sometimes when if a company's metrics are essentially so outside the norm that it screws your ability to use a normal measure. But anyway, total cash and short-term securities 448 billion. Long-term investments 1.7 billion. So 450 or so in general. The cash levels are probably going to be exactly where things leave it for you. Only about 4 billion in debt. Yeah, so negative capital. I see the math you're coming up with. Different people include slightly different, variables when they're calculating their capital number or whatever, capital employed or invested capital or whatever. Different people have different terms for it, and different people add slightly different things and subtract slightly different things from it. But yeah, the way I like to calculate it, I get a negative number as well. Not a hugely negative number, but a negative number nonetheless. It doesn't really matter. It doesn't make a huge difference. But yeah, it does kind of screw your ability to analyze a company though sometimes, because then if you come over to this return on invested capital number, you have to wonder like what's going on with there. Although of course this website, when they talk about their return on invested capital, they themselves do their own version of things. But yeah, let me look at some of the other factors related to them. No, oh, that's right. No estimates over here. Let's take a look at some of those other ratios. Gross margin, EBIT margin, unlevered cash flow. So relatively low gross margins, but I think that's pretty par for the course in this industry. So not necessarily super big deal. Or it was really low in the start here. We had some low years and then it kind of stabilized in some more middling levels, but still, yeah, not very high gross margins, but that's pretty typical for this kind of industry. But then the EBIT and cash flow margins relative to the gross margins are actually relatively high, which again is also kind of par for the course there. So we actually end up with pretty decent cash flow levels. As you can see kind of here, it kind of, we have a couple negative years right here, but some teen years, some low single digits, back to some teens. So maybe on average, we can say like, I don't know, 5 to 10% on a conservative basis, maybe closer to the 10% level. If we're only looking at 16 on, probably would be more like 10 to 12%. So it kind of comes down to like how similar was the business in these first few years compared to the most recent few years. So decent margin levels. Let's actually bring the return on assets up, which by the way, Ariane, here's the trick. if you don't like your invested capital number, if the invested capital number is giving you too much headaches, just go back to return on assets. Return on assets can be your way of combating that problem. Now, obviously, it has its own problems because return on assets is going to include non-operating assets like cash and securities and things like that you don't really want to be in there. But obviously that's part of your problem, right? Is subtracting those things from the capital number is why it becomes negative. So if your capital number is negative and it's giving you you can't analyze it very well, I say just fall back on return on assets. It's going to be a smaller number than return on invested capital always, but it's at least going to be scaled somewhat similarly, right? Because assets are at least the things that you buy with your invested capital. So you can kind of look at it that way. It's like invested capital is the thing that is invested, and assets are the thing that you bought with the investment, right? So yeah, that's kind of what I would say is the fallback. And so looking at that, return on assets, pretty strong. We have a few negative years as we were talking about right here, but even if you were to average these 3 negative years in with these relatively strong years right here, we might end up with like an average of 10% or something. I don't know. Which 10% return on assets would probably be more like 12 to 15% return on invested capital in a more stable situation. Which 12 to 15% return on invested capital is good. And that 10% average might be conservative too. It might be more like 12% return on asset average. So therefore 15% return on invested capital, which would be good, right? So pretty good, pretty solid. Take a look at cash flow, see if we see any weird things there. Yeah, they have a lot of cash. Yeah. But what I would maybe say to that question then is let's go look at the cash levels. What's going on with that? Here. Pull the cash levels up. Pull the assets up. So it looks to me like they always have a huge amount of total cash and investments as a percentage of their assets. Look at that. See? Like even in 2013, it's half as much. And 2017, it's like half as much. And that's like the lowest it's ever been, right? So here's a thing that they like, literally one of my finance classes I'm talking about right now, one of my professors specifically likes to hark on this point. which is excess cash versus your normal cash levels. So like when we're subtracting out cash from the invested capital number and from enterprise value, when you're subtracting out cash, technically speaking, you're not supposed to just subtract out the total cash balance. Technically speaking, what you're supposed to do is you're supposed to subtract out excess cash levels. And what that means is the cash levels that you do not need in order to operate your business. And one way you can think of this is like a Walmart or a retail business, right? Like they have all the cash registers. All the cash registers have some cash and some change in them. And you could never subtract all of the cash out of the business because you would need the cash in the cash registers in order to operate the business, right? And that's just one version of operating cash, but there's other cash too. Like the cash that you need on hand to make sure you pay your suppliers on time would also be operating cashes, right? So what I would say here is that technically speaking, you're not supposed to subtract out excess cash from invested capital or from enterprise levels. Now, the convention, the usual rule of thumb is to just subtract out the total number because we generally assume for the vast majority of businesses that the operating cashes are close to zero. Like even for Walmart, the amount of cash you actually need in those tills is usually pretty small, right? So that's why most investors usually feel pretty comfortable just subtracting the whole number out. So what I would say is that, and you bring up right there in your next comment, you're like, but that's hard to gauge which cash they need. You're absolutely right. The vast majority of companies do not tell you what the excess cash versus operating cashes are, which is why most people just assume that it's 100% excess cash. But what I would say is that if we're seeing something like this, it makes it kind of seem skeptical to me. It makes it seem to me like they need this cash. Now, I don't know that for a fact because I haven't looked at this company very closely, but what I would say is like, why is it that for 10 years, they have more than half of their assets in cash and investments? What's the reason behind that? Why are they doing that? It might be that they specifically don't want to go to debt markets or capital markets for their capital needs. Because like I highly doubt it specifically has to do with their industry. Like I don't think it's something about their industry that needs it. I think it probably has more to do with the dynamics of the market that they operate in, the South Korean market. Like maybe their capital markets, they don't like issuing debt there or something. I don't know. You see that, for example, in Japan. Japan's another place that has really, really high levels of cash relative to firm value levels. And they stay that way forever. So it's like one of these things where it's like, I don't know. They do have a lot of cash, and you could argue that that's confusing the capital number, but you could also argue that since that's never going to change, that cash is never going to come back to investors, right? And maybe it's because they're a young company. Maybe they expect they have high growth needs, and so that's why they have all the cash on hand, is that they expect that they're going to be able to buy things. I don't know, but all I'm saying is that in a situation like this where the cash levels seem to be like this consistently, I feel even more confident relying on that return on asset number that I was pointing out to you. Because it seems to me like these assets are normal. Like this is a normal situation for them. This isn't an abnormal situation. And so therefore this return on asset number seems to be pretty normal to me too. That's just my interesting take right there. Like I said, it's like what specific ingredients people count as invested capital is a super philosophical question that people can argue about until the cows come home. Which forms of investments do we count or not count? Which forms of minority interest and non-controlling interest do we count? Do we count goodwill? Right? Like all those questions about invested capital are very philosophical, and everybody tends to have very different answers to them. But yeah, so I don't know. If you're trying to analyze this business, I would say maybe just rely on this return on asset number as a good gauge, which by the way, still shows it to be a good business. Like I said, I don't know how comfortable I would feel surrounding like the consumer bases of this industry. It's definitely not my type of industry. But maybe if these player bases are reasonably not overlapping, like if they're addressing different segments of the market, well, then this could actually be a pretty interesting company. At least based off of the metrics I see here. I wish we had some estimates for the future, unfortunately. So I think that's probably going to be it for today, though. We've been going for an hour and a half. Appreciate all the questions, Mr. Beast and Aryan. I appreciate you guys showing up. Oh yeah, I didn't actually get to the valuation part of it though. I'll I'll take a quick look at that. Oh, and you're asking about the job hunt again. I did see the comment before, but I think I was in the middle of something, so I didn't comment on it. Job hunt is going good. I do have my current plans arranged for post college. I do have a position that I'm set for. I am looking for better ones still, so I'm kind of like still on the outlook of it. But in the last month or two, I haven't really been able to do too many more new applications. I've honestly been more focused just on my actual classes, and then all the other research for investing and economic data that I've been doing as well. But yeah, so I haven't been doing as much new applications the last month or two as I would have liked, because I am technically still trying to look for even better opportunities. But I do at least have my current stable fallback option that I feel pretty happy about. So yeah, just looking forward to finishing the degree. Almost done, home stretch. But yeah, so I don't know, if we at least just zoom in here on the period of time where we have positive multiples, we can see an average EBIT multiple of 7.3 or normalized adjusted PE of 13.3 relative to currently trading at 4 for the adjusted PE or 1 for EV to EBIT. Obviously, we've talked about the enterprise value situation there, so why we would end up with such a ridiculous EV to EBIT number, at which point you almost just want to rely on the equity value number. So you might as well just rely on the PE at that point once you have an EV like that. You want to include the debt to cash levels, but if it gives you such a screwy number, you might as well just fall back on it. At which point it still appears to be at least half as cheap as it was a year ago, and possibly even more significantly cheap than it has been in the past prior to that. If we're just focusing on the average of that, it's on average been, like I said, about 11 to 13 or something like that over this relatively short historic time frame, only going back to 2017. So even just on that basis alone, you can see a doubling or a tripling, assuming it was going to go back to that same multiple. If we assume that there's interest rate adjustments to that multiple as well, maybe this 13 gets crunched down to maybe a 10, a 9 or a 10 or something on an interest rate adjustment level, and that would still give you possibly a doubling from the current multiple there. Trying to start a hedge fund, yeah, I mean, I definitely would enjoy doing stuff like that, but there's some annoying regulatory hurdles you have to get through first. So we'll see if I can get some of those certifications unlocked first in the first few years of my career. But yeah, so on a valuation basis, it sure is looking cheap too. So like I said, it's like my only questions about this one would really just be about the long-term viability of those revenues, wondering whether or not those customer bases are going to melt away. But assuming that those customer bases could maintain even their current levels for the next 10 years, it looks like it probably would be set up for a banger. It's just a question about those customer bases. Yeah, definitely. So yeah, okay, that's going to do it for today. I want to make sure I actually closed out Gravity with an actual assessment of the value and not just talking about the fundamentals a little bit. But yeah, so I appreciate you guys hanging out. Please hit the like on the way out, hit the subscribe button if you haven't already. Feel free to donate to the channel if you're so inclined. Make sure you join the Discord if you haven't already as well. All right, I will catch you all next week, and maybe I'll be working on another valuation video this week. I don't think I'm gonna get a video out this week, but I am working on one this week, so maybe next week. But I will at least hopefully be live again next week. So I'll catch you all next week. All right.